Welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we're diving into one of the most fundamental but often misunderstood distinctions in stock investing: large cap versus small cap stocks. If you're just learning how to analyze stocks as a beginner, one of the first strategic decisions you'll face is this: should you be investing in big, established companies or smaller, up and coming players? That question sits at the heart of how you build a portfolio that actually works for your goals and your comfort level with risk. Now, when we talk about large cap and small cap, we're referring to a company's market capitalization. That's the total market value of a company's outstanding shares. It's a simple formula: stock price multiplied by the number of shares. But while the math is easy, the implications for your investing strategy are anything but. So, in this episode, we'll walk through the key differences between these two categories, break down their pros and cons, and help you figure out how they fit into your portfolio, whether you're just starting out or looking to rebalance. Let's get into it. What are large cap stocks? Large cap stocks refer to companies with a market cap of over $10 billion. These are the names you already know: Apple, Amazon, Microsoft, Coca-Cola. They've been around. They've survived market cycles. They're the giants of the stock world. So why do investors love them? Let's look at some defining characteristics. Stability. Large cap companies are typically well established with predictable revenues. They're not likely to go bankrupt overnight. Dividends. Many large cap stocks pay out dividends. That's free cash coming your way, often quarterly, which can be reinvested or used as income. Lower volatility. They're generally less sensitive to day-to-day market drama. Institutional support. Mutual funds, pension funds, and large ETFs often have heavy allocations in these stocks, which adds liquidity and reduces volatility even more. Strategically, large cap investing is all about long-term stability, wealth preservation, and steady growth. If you're following a dividend investing strategy, this is your go-to territory. These companies tend to deliver solid returns and offer regular income streams. Large cap stocks also fit nicely into global diversification strategies. Many of these companies operate on a global scale, so even though they're headquartered in one country, they earn money around the world, which helps reduce exposure to any single economy. Risk-wise, it's low to moderate. You won't see your investments double in 6 months, but you also won't see them collapse in a flash crash. The trade-off here is predictability over explosive growth. What are small cap stocks? Now let's talk about the underdogs, the small cap stocks. These companies typically have market caps between $300 million and $2 billion. You probably haven't heard of many of them, and that's the point. These are the startups, the disruptors, the regional players hoping to go national. They operate in niche markets, or they're early in their growth cycle. So what makes small cap stocks interesting? High growth potential. Unlike large caps, they're still scaling. Some of them are doubling revenues year over year. Volatility. The flip side of growth? Risk. These stocks can swing wildly. Limited analyst coverage. Fewer analysts are watching these companies, which creates opportunity for diligent investors who do their homework. Reinvestment over dividends. Most small caps don't pay dividends. They reinvest their profits into growth, hiring, marketing, RD. Who should consider small cap investing? This is for the investor who's comfortable with higher risk and has a longer time horizon. It's a great space for those leaning into value investing versus growth investing, especially growth. If you're ready to dig into fundamentals and technical analysis, small caps offer a lot of opportunity. I highly recommend listening to a good fundamental analysis podcast or finding tools to help you understand income statements, balance sheets, and growth metrics. But be prepared, this isn't passive investing. Small cap stocks require ongoing attention. Risk profile? Definitely higher. They're more sensitive to economic downturns and don't have the cushion large caps enjoy. In a bear market, they get hit harder. But in a bull market, they often outperform. Historical performance: small cap versus large cap. Over long periods, small cap stocks tend to outperform large caps on total returns. But remember, that outperformance comes with higher volatility. In good times, small caps lead the charge. In downturns, they fall faster. That's why diversification is key. You don't have to pick one or the other. A well balanced portfolio blends large cap stability with small cap upside, matching strategy to experience and risk tolerance. Let's talk about you, the investor. If you're new and still learning how to analyze stocks for beginners, I suggest starting with large caps. They offer a stable sandbox to play in while you learn. Start by exploring a beginner friendly platform like crystalballmarkets.com. It's designed to help first time investors build confidence with simple tools and educational content built in. Now, if you're intermediate or advanced and you've got some experience reading earnings reports, applying moving averages, and assessing company fundamentals, start mixing in small caps. In fact, a smart move is to create a hybrid portfolio. Anchor it with large cap dividend stocks and layer in select small cap picks for growth. That way, you balance upside with security. Practical tips for picking stocks by size. Here are some tools and tactics you can use today. Use stock screeners. Filter by market cap and combine it with fundamentals like P/E ratio, debt levels, or ROE. Tune into expert content. A fundamental analysis podcast or YouTube channel can speed up your learning curve. Track performance. Keep a journal or spreadsheet. Log what you buy, why you bought it, and how it performs. Diversify sectors. Whether large cap or small cap, don't put all your eggs in one industry. Rebalance regularly. Markets shift. What was once a small cap might grow into a mid cap. Reassess every quarter or year. Final thoughts. Finding the right fit. There's no one size fits all answer here. The right stocks for you depend on your financial goals, your comfort with volatility, and your experience level. If you're just getting started, stick with stability. Build around large caps. If you're experienced and ready for more risk, start blending in small caps strategically. And don't forget, there's always help out there. Platforms like crystalballmarkets.com make it easier to explore your options with confidence. Want more guidance? Tune into the Crystal Ball Markets podcast for expert tips, trends, and analysis, especially helpful when you're navigating complex ideas like value investing versus growth investing explained, or searching for the best stocks for beginner investors in 2025. So, whatever your strategy, learn the tools, stay curious, and match your investments to your personal goals. Until next time, I'm Sophia, and this has been Financial Market Insights for Traders. Stay smart, stay focused, and keep investing in your future.